Welcome back to another live show here with my mystery underwriter. Oh my God, you guys. This is Tom Kraft. He is a senior vice president. He's kind of a big deal. I begged him to come because it is ridiculously hard to get an underwriter to commit to doing anything social. And so he is super awesome. He's been in underwriting and operations and mortgages for like longer than I'm going to admit because he'd probably kill me.
Great, thank you. Well, thanks for having me. This is exciting. This is my first approach, I guess, into YouTube Live, and I'm excited to be here next to you and looking forward to it today.
Yes, so turns out Tom's also left-handed, which is why I'm on this side today.
Sorry about that.
No, it's super fun. Go ahead, guys. Let us know where you're tuning in from. Let us know what stage in the process you are. Also, let us know if you're tuning in from a random place like Asana, like Steven is. We definitely want to know. While you guys are posting that, I am just going to give you a quick market update. So interest rates, guys, they're not doing super hot. We've definitely seen some bumps in interest rates, primarily because we're getting positive news about the economy. You know, several people from the Fed came out this week and said, you know, that the economy is making major progress. They still believe that we have lots of strides to go. And we have, you know, the Delta variant that might just put us back in shutdown mode. So it's not for sure that, you know, the Fed is going to be tapering the asset purchases of mortgage-backed securities. But guys, it's looking like that, and so we definitely want to be cautious. So if you are somebody who's in the process of buying your home, refinancing, now's the time to get the best rates. So just an FYI. Also, guys, CoreLogic just released their latest data on rents. And so if you're somebody who is on the sidelines with wanting to rent, home prices are definitely going up. They've definitely not going up at the rapid pace that they were from last year. So one of the stats that I read was that, you know, we're up like double digits, like close to 30% from last year, but we're down 6% in appreciation month over month, which is helpful to know that it's still a very competitive market, but we're not going to continue to see the rapid appreciation, which over time will make it better for you guys as buyers. But for renters, guys, this is where we're now seeing like major movement. 7.5% increases in rent alone. I think, what was it? Renaissance Homes or Invitation Homes, which is the largest provider of rental homes, guys, just announced that they're going to be increasing all of their leases 6%. So you guys just want to be really aware that sometimes the benefit of home ownership is that you get that fixed payment right now at historically low rates, and that payment isn't subject to rise like rentals are going to. So just an FYI. All right, so let's say some hi to some people and get to answering some questions. Hello, Steven. Thank you for always tuning in. I appreciate you guys so much. We have Nayeli Rivera. We've got Carlos. We've got Zeke and Jen. Rogelio, Miss Shadow Llama, Arnold, Narcisse, and Natalie. So welcome, guys. Appreciate you for tuning in. So we'll go ahead and get started with Nayeli's question, which is, my agent wants me to sign documents that state I'm forgoing my warranty and inspection. I'm not signing that. Would you happen to know what he may be talking about? This is for a new build. So I am not a real estate agent, so I'm going to preface that with you need to get another real estate agent's advice. But to my knowledge, when you sign the new build contract, typically they have builder warranties. And so this is an additional home warranty. You can always purchase a home warranty, just so that you know. And I don't believe that you have to forego inspections, but they do have their own building inspector on site, and then you will be meeting with them. They do have to build a house that's quality. I mean, these are large builders that you can sue if they do a bad job. So generally speaking, on new builds, I don't know that it's as big of a risk as it might sound, when you're signing that paperwork, but you will want to seek out, a real estate attorney or an actual other real estate agent's advice on that specific question. Anything you want to add to that?
No, I agree that the home new builders will have their own warranty, right? That's in place, so they could be referring to an additional warranty on top, which may not be needed, or maybe if you want to get more comfortable. But No, I'm with you. Same page.
Now, if it was a resale home, I would definitely have a different answer to that. Especially Tom here, who was telling me he's been living off of his home warranty for like the last
I
month.
highly recommend a resale home. Definitely spend the extra money even to buy a more enhanced home warranty. It does come in handy, even for some of the little things. So yeah, I'm a huge advocate of that.
So I have to ask you, right? So you're senior level vice president underwriting, the guy who knows everything. You just went through the home loan process. By the way, I was not his loan officer. So just want to preface that. How was the buying experience knowing all the things that you know? Is it like more frustrating? Is it more stressful? Do you just like, you know?
It's a great question. I think it was helpful that I knew the in and outs of the process going into it, and it really gave me, I think, a different perspective of what I do every day at my job, right? Handling the credit side of it and really being on the consumer side of it. So it really was an eye-opener for me to maybe be better in my communication, my clarity of what I'm asking for versus a lot of the jargon, right? Because there's a lot of different components, a lot of different players in place. I think ultimately at the end of the day, there was a little bit of frustration because you really want to kind of put your own approach with someone else's underwriter, yet I manage credit for a company on this side. So there's some of that frustration, but I think overall, just having more awareness around the entire process was just a great eye-opener and really, I think, able to help me put a different perspective on what I do on a day-to-day basis helping consumers.
So Tom is excellent at being political, which I love. So let me translate this. So when we're in the business, we have a specific way that we would pre-qualify someone or underwrite a loan. And underwriting is subjective, which is one thing that I think that all of you guys should get out there. Even though that there's a list of guidelines, it also has to pass through somebody else's comfort level. And so sometimes you get these conditions that are just to appease somebody's comfort level, and it wouldn't be the way that you would do things. And so then it's a contest of like who's right. And I personally, on my own home loans, I pre-qualify myself. I feel like I've provided all of the details. I've dotted all the I's, I've crossed all the T's, and somehow I always end up in a fight with someone. I'm not sure how. I try to like not be involved as much as possible. I let my husband do it because if it's up to me, I'm like, no, you don't need that letter of explanation. Or whatever. But so it's super funny to have us go through the process, because also the thing that I think that surprises people is it's still stressful for us. Like, even though you know you're qualifying, you like don't know if you're qualifying. It's like awful. It's like, I don't know.
No, and you really are. You're still on pins and needles right through the whole process, through the inspection process and, going through the appraisal process, right? It's very, it's not even anxiety, it's not the right word, but you're anxious, right? To go through the process, and you're excited at the same time because you're buying a new house. So, yeah, all those emotions are going.
And we also know like every bad thing that could potentially happen. So funniest story ever is that I did actually do a home loan once for an underwriter who was like the biggest freak I've ever encountered. He was so up my butt.
I know exactly what you're talking about.
He was so neurotic about his own home loan, you guys. He like called every single day for like 15 updates. And that's just because we know of all the crazy things that can go on. So
true story.
Too funny. Did that break the ice? That make you more comfortable?
True story.
Okay, I'm a little less political than Tom. Okay, so let's get answering. Okay, so Steven's from Orlando. Love it. Steven is a newer loan officer. So Steven, so for those of you guys who are variable income commission, maybe work on tips, I put out a video today for how you guys can qualify, especially if you've ever had a gap in employment due to COVID. Great video for you guys to watch if you do not have a salary or set schedule. All right. So lots of people from Florida. Love it. Rogelio from LA. Love it. Boston, Massachusetts. Love all these East Coasters, guys. This is totally Lizzie after hours, by the way. I also cuss a lot. New York. Okay, so let's get to Theo. So how does HOA affect HELOCs? I have a paid off investment property. I'm looking to pull a HELOC out and want to know the max, I think, percentage. So here's the thing. HOAs impact your debt to income ratio. I don't think they have any kind of stipulation on how many mortgages you can get out. One thing I will give you a caveat on is that right now that interest rates are historically low, sometimes it doesn't make sense to pull out a line of credit because those are variable and they're subject to change with interest rates changing. Now, that being said, if it's a small amount, under 100,000, you're going to use it intermittently as you need it, maybe for a home improvement project and then pay it off. By all means, line of credit it, but your HOA shouldn't have any impact on that. And you may need to disclose what the HOA is to qualify for your HELOC. So I hope I answered your question. I felt like that was kind of cryptic.
No, I really.
So basically, if I didn't answer it right, it was your fault. I'm just kidding.
No, just to your point, I think I would consider not only the HELOC option, but just maybe a regular cash out refi with the rates at the levels they are. Might probably do a little better security and longer term protection with your rate.
Awesome. So Theo is a first-time listener, heard about me from Matt the Mortgage Guy. Oh, that's so cool. You guys, guess who made it to the live stream? It's Kyle. Kyle from Win the House You Love. So exciting. Pumped that you finally made it to a live. Okay, guys, so I got a bunch of written out questions, and these were the questions that were sent to me from last week's live. The one where our favorite underwriter bailed on me.
That's the rumor. But your new favorite is here today.
Yes, my new favorite, my SVP. Okay, so these were the questions that were asked. So the first one was, when does the underwriting process start in new construction? And they're several months away from closing.
So, you can start really with your pre-approval process, right? And that's putting together your assets, your income, going at the pre-approval, and at least having the credit report pulled and having all of those, I would say, those concerns handled up front, right? Obviously, that's before, in some cases, even breaking ground, et cetera. But I would recommend going through a formal pre-approval process and then proceeding forward with that. There'll be a renewal period, right? There'll be times where your credit docs might expire through that new construction process, which is quite normal, right? Depending on the time it takes with the new build. And then we'll go through the updates, providing updated pay stubs or updating bank statements as needed. But from my perspective, I would jump on as early as possible, right? So your credit approved. I'm sure your builder will be happy you have that in your hand as well and work from there.
Yeah, so most new build contracts have a date for when you have to be formally approved with underwriting, and they will not typically start the build on your house until you have that. Now, that being said, when he said you have those renewal periods, one, I think, of the most frustrating things that happens with new construction, especially now that build dates are getting extended, is that you have to repull credit every 120 days. And credit documents, we have to verify every time you put a deposit in. So sometimes you're providing us with months worth of bank statements, which I definitely think frustrates people. Because whenever you have bank statements, there's always questions sometimes about deposits and about reoccurring expenses that come out. And so that always adds additional conditions. And then sometimes you will have a lender order an appraisal way before they should have, and then you have to get a recertification of appraisals. So there are some frustrations whenever you're in the new construction process and you're getting pre-approved so early on in the process. But typically it's required by your builder. And what I always recommend is that people set up a folder on their desktops where they're saving all their bank statements, all their paycheck stubs. And don't get your credit run too many times. All right. So Win the House You Love says, could we talk about underwriting exceptions in those instances where there's a gray issue is evaluated by an underwriter and underwriting manager? So this is how Tom and I are buddies. I'm the queen of interpretation.
Yeah, and I think that's exactly right. Underwriting's subjective, right? Albeit you hear the jargon of automated underwriting approvals and AUS, all those fancy names, but at the end of the day, it does become subjective. And, is there exception lending? I would say yes, there's exception lending, but I also think there's a way we work together. Lizzie and I do this every day, the way you work together and how you document a file, right? To put together the story and the case to work around maybe situations that don't exactly meet a published guideline.
Yeah, so a lot of times whenever we're going in for what is considered a gray area, So like for instance, I recorded that video on the gal who had been denied by 2 different lenders. And part of the reason that she had been denied is because the guideline states that you have to average the income for the last 2 years whenever something is considered variable. So not a set schedule of hours, right? But it doesn't say how you need to average it. And this is where the interpretation comes in. So I get that loan, right? I'm not just averaging what she made because the gal has now had 2 increase in earnings. And not to mention, there was a period of time where she took a gap because of a medical issue, which I can subtract. I can't subtract the time for COVID because that's not the guideline. But there are some things that I can do with the guideline and then go to him and say, hey, the client has worked an average 1,300 hours per year. She now earns this pay rate. Can I average the hours at the new pay rate, right? That's how you get an exception done. That's how you interpret gray areas. And not everyone is willing to understand, like, this is what the guideline says. How can I still meet it, right? It's not just like, I like this person, they have great credit and great assets, right? You have to be able to substantiate it with the actual rule.
No, absolutely correct, right? It's how you build the structure and the foundation around that guideline, right? So you can support those decisions, right? If anyone comes back and questions us of why we want to make those types of loans.
Yeah, and also there's can you elaborate a little bit on, there are some loans that have like, what is it called? Where we add additional information to help support it, like extra income if we can't use it, or extra assets.
Yeah, so compensating factors.
Compensating factors. We were in charades.
All right, I added value. Yeah, so compensating factors are, there's many of them. I can walk through a handful that I think stick out more than others. But I think that's a big deal, especially in today's market, right? And people's income look different, right? Asset structures look different. There's many different types of approaches out there, and I think some of the key areas, when we talk investors, from the folks making the loans and the loans, the people we're selling loans to, is, what are the other, we would say, non-guideline things that are evident within a borrower's and customer's profile that makes the borrower creditworthy. And the number one thing there is, we're going to start looking at credit history, right? I mean, one of the things now that's recently come out is, looking at a borrower's rental history in the overall credit evaluation of a borrower.
Guys, that's going to be so huge.
And that's a super big deal where we're able to look at bank statements and look at a client's rent payments and determine creditworthiness. That's a really big deal. Before, that was very subjective of just an underwriter looking at bank statements or a piece of paper, but it's being built in to decision-making models in the industry. So that's a big deal. Assets is always a big plus. Someone's savings pattern and savings history. Credit as well, right? It's not necessarily a credit. Are you a accumulator of balances, or are you just a user of credit? Right, using a credit.
Or have you just not used credit?
Absolutely, right, by choice.
Like some people, like all our Dave Ramsey lovers, like they're so terrified of having a credit card, they typically have no credit, right? And so then we would use alternative trade lines to qualify them and things of that nature. Now, whenever I think underwriting gets the most subjective, it's when you're doing a manual underwriting.
That's right, and we do have scenarios, right? We'll have jumbo loans, right, out there that is pretty much all manual underwriting these days, right? And that's, again, we're looking at those factors. But there's also loans, and this was one of the questions from last week with the agencies, Freddie Mac, Fannie Mae, where if you have a borrower who doesn't have a credit score, right, we can entertain doing a manual underwrite there, and you're going to also look at similar compensating factors.
Yes. So again, guys, compensating factors, if you have them, additional assets whenever you can show like multiple months of additional mortgage payments in the bank. If you have additional income that we can't use, maybe bonuses that haven't been received for more than a year, commission income that hasn't been received more than a year, if there's a non-borrowing spouse or additional people in the household contributing, right? These are all things that can help strengthen up your file. And if we have to underwrite it manually, which you can do on conventional VA, FHA loans, right? This is the stuff that helps us push us over the edge sometimes when it comes to approving or not approving someone.
Yeah, and you really hit, Lizzie, I think a hot topic as well on commission bonus, right? Guidelines are specific out there. They're looking for a 24-month history. Yet you can consider in cases a borrower or client who has greater than 12-month but less than 24-month history. Right? And we'll look at those if they earn bonus or commission maybe at a previous job, same industry, similar line of work, but you're over 12 months, less than 24. So those are things we will look at. They maybe kind of fall on the exception basis, but more of compensating factors, right, to really want to use that income based on the entire profile of the customer.
And you actually just reminded me of something super important. So guys, a year ago, well, actually before COVID, lending guidelines weren't that different between bank to bank, truthfully, right? Like your big institutions have their own, what we call overlays. So they're overlays to whatever is going to be insured by Fannie, Freddie, FHA, VA. But since COVID, and because banks have to have so much liquidity based on the number of loans that they service, so they actually have to have enough reserve assets to be able to support their pipelines of people paying them. So what's required now is most banks overlays their own thresholds for what they're willing to loan out. So let's say you're not getting approved in one bank, it's probably smart in this time frame, right, to shop it around multiple places, right? Because people's comfort levels and their own overlays, that has changed. Banks are actually different.
Yeah, and I would say that's one of the things we've done really well, right, within our organization, is really try to limit those overlays, but that is definitely something to question, right, when you're running into maybe one lender not willing to look at maybe bonus less than 2 years, right, where it's something we will look at and make a make sense decision.
I see the biggest thing with credit scores, guys. So the agencies allow for lower credit scores than I see most banks offering. So I see banks saying, hey, you have to have a minimum 680 FICO score for a conventional loan, or I see them saying you have to have a 640 for FHA, and those are overlays, right? So those are not the actual guidelines. 620 for a conventional loan. It's 500 technically for an FHA loan if you have 10% down. So you really do have to do your homework, right? And then do your due diligence and shop around. God, yes. Some of these words are so big nowadays.
Makes you feel important.
I'm adulting. Too funny. Okay, so Brave Bird said, it's been 1 year since bankruptcy due to extenuating circumstances. Should I wait one more year or divulge if crazy for FHA? Well, it depends on how bad you want the property. Okay, so that's what I'm going to say. And a lot of lenders, so this is an area, guys, that is absolutely subjective to underwriters. So I'm going to tell you that if it's not death of a wage earner, severe illness, significant job loss or income loss that is not because you got pissed off and quit your job or decided to relocate to a different state, it's probably not worth checking in. The last time I got an extenuating circumstance done, guys, the amount of PI work I had to do was insane. Basically, my clients had, this is how crazy they have to be. My clients were getting divorced because the wife just had got addicted to drugs and was the primary wage earner for the household. I had to document her entire drug use. Thank God it was available online. But I had to seriously document it, show that she was the primary wage earner, show the history of loss, show the recovery, show that he had now payments for over a year on his own. We had to definitely show compensating factors. I mean, it was over the top for what we had to show. And guys, it is so difficult. So it has to be so worth it to you, right? There has to be a house that meets all of the buy box criteria for you to, you're going to be divulging several years of tax returns, lots of letters of explanation. You have to have data to back up your story. Did I dissuade everyone from doing extenuating circumstances?
No, I was going to say, and there's some alternative products out there today that fall under the non-qualified mortgage umbrella that don't have any wait time, right? So there's some non-traditional products out there that worth a conversation. Again, there's other components to that, in terms of pricing and things of that nature. But if it's really a home, right,
So,
that you're interested in.
question for you, because I've seen those non-QM loans, and they're typically at like way higher interest rates. And so remember when I told you guys that everybody's own money mindset impacts their ability to be a good advisor? This was mine, right? So generally speaking, when I see those, they require, 20% or more down, and then they're at like way higher interest rates for people. And so for me, in my mind, somebody who's just maybe filed for bankruptcy or just lost their home, like, I'm just a lot more conservative in terms of my finances. So I didn't even think of it, which is why it's so awesome to have Tom here.
Yeah, and I think it's, there's just so much out there in terms of a menu of products, right? To your point, it may not fit everyone's, need, but if someone's looking for a house and if the price still might be right, and the rates aren't, 9%, right? Like they used to be. There's times where you'd pay for that risk, but again, it's still an option, right?
Okay.
And I think that's maybe the point there more than anything else, right? It's still an option to consider outside of that.
100%. So I will be studying the non-QM guidelines regarding that. Now, one caveat I will say that if you filed a Chapter 13 bankruptcy and you've made on-time payments for a year, that actually would not be an extenuating circumstance on an FHA loan. So it sounds like you did a 7. So hopefully this was helpful. All right. So Kyle says, I feel like there are lots of lenders pushing non-QM, but I don't see a lot in practice. So I do get quite a bit of broker emails about non-QM products. We actually offer a lot of non-QM products. We have a lot of secondary financing, back, and that means that guys like big hedge funds are backing some of our loans,
Correct. Especially
especially when it comes to second homes and investment homes. So that's an area that we've really been able to provide and continue to provide financing on. So I do see it practiced quite frequently, primarily with Canadians, primarily with stated loans. Where else do you see non-QM?
Yeah, it's becoming a larger portion of the business I run into on a daily basis. So much of it will come around. I mean, the hot topic now is the buy before you sell on the non-QMs. So there's some products out there that will allow you to exclude your PITI, your principal payment on your departing residence in your loan calculations, depending if you're going to rent out your departing residence or you're going to sell that. So there's some extra reserves that are required in there, but it does give a nice opportunity to really buy before you sell and then work that route. So that's been a big one in certain markets because inventory is going so fast.
And having a contingency on your offer basically kind of bumps you.
Absolutely. Yeah, you lose a couple notches, right?
In
your offer, for sure. And, job gaps is a little different sometimes in non-QM, right? A QM loan, your more traditional, requires 6 months back after you've had an extended job gap. There's product out there today that you don't have to wait the full 6 months. Again, income streams, right? We're seeing much more asset depletion, asset qualifier loans out there that really where you have a cash-rich, cash-heavy borrower, but maybe can't document the income in a traditional fashion, so we can use those assets for income. And bank statements for self-employed borrowers is also a nice product out there right now, especially given, looking more at cash flow versus your traditional tax return analysis.
Yeah, so the biggest thing there, guys, for those of you who are self-employed and maybe you haven't reported enough income on a tax return, so what these asset loans do is that they verify the number of deposits that you have on a business bank statement, and they use that as the average of income. Now, you do have to support that you are in business with a business license, a third-party verification. I mean, they're harder to qualify than the previous stated loans of the last catastrophe. So so they are harder to qualify for, but again, that's where I typically see a lot of non-QM relief.
Yep.
All right. So, and Kyle says he agrees with me. One non-QM loan, 9% rate with Chapter 7 bankruptcy. See, I thought it was 9 to 10%, but I don't know. Yeah. I haven't done them. I'm not even going to, I'm not going to hate. Jesus, yes, you can use an ARM for a primary residence. I will tell you that there isn't a huge difference right now with ARMs and 30-year fixed rates. And so I would have to ask you why you would want to do that when rates are so low. All right. And then Yomar says, currently on a conventional loan and depending on the interest down the line, might look at refi question. When looking at a refinance, when is it best to pay down closing costs, current rate in low threes? So here's what I typically always do. I always have my team do where you're at currently with your home, and then where would you be if you did a refinance? When's your break even? So there is a cost to doing a refinance, whether you pay it out of pocket or whether you include it in your home loan. When do you break even in terms of monthly savings versus the cost? And then how long do you plan on being in the property? Generally speaking, if you're not going to save more than $200 and be in the property more than 4 years, I just think that you're wasting money. Lots of people refinance, guys, to save $50. And yes, if somebody sold you on $50 for 30 years, it looks like a really big number. But you also have to factor in the additional years that you're going to be paying the mortgage, the fees that you paid, and the likelihood that you're actually going to sell the house before that even happens. And so those are my rule of thumbs. I think that you're way better off just applying additional monthly savings to your principal balance and just paying off the thing way faster. So there's that. Okay, so Brave Bird is asking us about student loans. How student loan guidelines have gotten so much better, don't you think?
Yeah, and it's a question that comes up, and it's one I always have to look up because it seems to be changing often, right?
Well, right now I currently happen to know them all by memory. So it's Fannie Mae is either income-based repayment plan or 1%. Freddie Mac is 0.5% or whatever's on your credit report, and then FHA is now whatever's on your credit report or 0.5%, which is so freaking awesome.
That's the latest change, right?
Oh my God, it was like, I'm like, how can you have an affordable lending product and have the most hardcore, like,
because Freddie Mac was leading the pack there, right, with the half. So yeah, that's a big win. That's
totally.
A big win.
So super huge win, guys. So so is student loan always calculated at 0.5% as debt? So here's the thing, no. It depends on the type of loan that you're qualifying for. So if you're on an income-based repayment plan, then you would then that would be the payment. Now, I understand that the federal government has deferred everybody's loan, but that is also a choice. You can call, excuse me, when I talk a lot, I like suck in all this air and then I have to burp. But you can call and just get yourself off of it and get the income-based repayment plan. If it's in deferment or forbearance, we are going to have to use, the 0.5% or the 1%, depending on the loan you're qualifying for. So, did you like my hand?
That was good.
Okay, so I'm really interested in getting into underwriting. So this is the question. So just so you guys know, fun fact, I started as the receptionist, went into processing, and then was on my way to being an underwriter when the mortgage market collapsed and I decided to become a loan officer.
Excellent.
Mainly because I couldn't get a job. So if you were going to start in underwriting, right, what's the pathway for somebody to do this?
My path to the credit side of the house, it really started with processing. And I think processing is such a fundamental part of the entire loan process. To me, it's really kind of the hub and spoke, right? It starts with processing there. And I think learning and partnering up, right, with not partnering up, but partnering up with your loan officer, right, and working close to the clients at the processing level will really start to help you understand how to put a file together, right? What trigger points, what tips and traps can be in a file as you work through it. How do you anticipate those? And then you can learn how to really present that file, your best foot forward, right into underwriting.
But how many years as a processor you think before you can go in underwriting?
To me, it's at least a minimum of 1. 2 would be ideal, just so you can see multiple scenarios that come across. I mean, I spend the majority of my day, right, working in the credit, working with different regions across the company. And, we're talking 300-400 questions, a week. And there's still times where I'll get a question I haven't seen before, right? So I think you at least want to put a good year, if not a little longer, in the processing side to really get your feet wet in all the products, the nuances on the guidelines like we're speaking to, and experience some of those tips and traps.
So I'm going to tell you that from somebody who hires people with mortgage experience, unfortunately, I'm probably not going to hire you if you only have 1 year of processing experience to be an underwriter. I started as the receptionist, and so there are going to be entry-level jobs like a receptionist, a loan opener, if you are just brand new to thinking about mortgages, where you can really get your feet wet. The way, like, so many of the top people that I know of actually started as the receptionist or like in this loan opening position, and they were willing to do the 1+, right, on every single loan. In my experience of training loan officers, training loan processors, you have to see at minimum 200 loans before you are proficient, before you know exactly where to go, how to structure a loan, how to troubleshoot an underwriting that maybe isn't approving, right? Like, there's so many things. And even now to this day, there's sometimes I talk to people who've been in the industry for a really long time, and the first thing I'm saying is, like, did you read your findings? And so it's a lot of times it's going to take that long. So I think 1 year is probably too minimal. I think 5 years is probably a good amount of years to be in processing before applying for an underwriting position.
I guess I'll give that to you.
I don't know.
No, I think it's no,
I'm
I'm with you. I think it's given the wide variety of product too, right? If you're focusing on FHA, government, or just agency business, but I think processing experience is vital as you move into underwriting.
So I kind of got a hardcore question for you. This is like, this person emailed this to me
is on the
3
spot.
times, and I was like ignoring them because I don't like people that are rude to me, in their questions or their comments. And so, but then I was like, you know what? I guess this person really wants this answered. And it says, third time round. Why did a bunch of foreclosures happen in 2008 if underwriters were doing their jobs? Did they just drop the ball on millions of applicants?
Wow.
3 times they asked me this.
So I've been in the industry long enough to experience all those ups and downs over the last 30 years. 2008 was a really interesting time. I think 2008 compared to today, the major difference is the credit standards that were in place. In 2008, the credit standards that were out there that we were making decisions on were not as stringent as they are today. I mean, that's just the reality of it. I can give repeated examples, especially when we talk about stated income loans, where borrowers, let's say it this way, it's more than just a lender issue from my perspective. It was an industry-wide issue, it was a consumer issue, it was a lender issue, it was a Wall Street issue, it was a broad issue, right, that happened to us in 2008. And yes, a lot of it had to do with greed, let's be fair there. But I also, we need to be fair and look through a lens now, especially looking back, which is why I think things are so different as we go into these alternative products, is, think back to the stated income days in 2008. You can pick a variety of different occupations where stated income would be at levels that maybe really weren't commensurate with what they were earning, right? I'm not going to pick any specific, occupation out there, but people would put down, I make $20,000 a month doing X, $15,000 a month doing Y. And based upon the guidelines in place at that time, that's what we followed, and that's the loans that were made. So, I think there's a lot of blame to pass around. And, I think from there we learned. And that's why when I'm kind of excited to talk about what you probably picked up on, these non-QM, these alternative products out there, I see the way these new guidelines are built with, an eye on credit quality, which gives, me personally, and I think this industry, a better sense of comfort as we move forward during the cycles of the, mortgage and the housing market.
So,
is that political?
Yeah, totally political. So here's the thing, right? So an underwriter is just going to do the job that they're given based on the credit guidelines for the bank, right? And so there was a lot of people making a lot of money on mortgages and real estate, and we were all being stupid. And the thing is that, like, just in general, I see a lot of the same practices happening now with cryptocurrency. I know some of you are going to roast me. But the thing is that, like, people are like, there's just no penalty. You could just buy it. It's the future. It's going to keep being worth more and more money. And you're so dumb if you don't get in now. And there's so much peer pressure along with it. But goes up and then people lose everything all the time. And I think it's just so crazy. And it's the same guidance I give with people buying in today's market. It's like, this is not a market for every single human being who, if you are somebody who cannot afford to purchase real estate right now, please don't commit yourself to a 30-year fixed mortgage. Like, one of the most awful things I did to myself is overcommit myself financially to a 2-year ARM on a piece of property that then was worth nothing 5 years later. Now, because real estate is a long-term investment, that home today has more than $100,000 something in equity from what I bought it from. And would it have made a good sense? Absolutely, but I did not buy it with the right fundamentals. I did not check my budget. I did not have proper assets, and I bought it with the plan that my brother would be my roommate. It's like, hello, who wants to live with their brother as an adult? I mean, honestly, I just wasn't thinking. But it was because everyone kept saying I was going to be priced out of the market, and we just do this a lot. And I just, it's so frustrating to me because consumer sentiment is never factored in as a reason why bad policies are made. But truth be told, also about the mortgage catastrophe, it was 1% of bad loans written. And then like once one person foreclosed and their neighbor then short sold, everyone was like, well, should I short sell? Should I foreclose? And then you had the domino impact of like, and then so that you could be cool at your party, you're like, oh, I'm not really broke. It was a strategic foreclosure. And it's like,
it became a financial planning tool.
Yeah, it's like, what is that? And so I just want you to know, so yes, and I'm not going to blast you because Jen didn't let me put their name on this list. Yes, it's a lot of the banking industry's fault for what happened, but I promise you it's because it's what people wanted to buy.
That's right.
So there's that.
Yeah.
All right. So, guys, definitely list your questions. Sorry, Tom and I have been talking a lot. I haven't seen him in a while, and so I was very excited. So, definitely we want to answer your questions. I'm going to answer a couple more that were emailed to me last week, but definitely post your questions. And, guys, it would mean a lot to me if we could get your thumbs up, please. Alrighty. So, let's see here. I have to ask you something, and I get this question kind of a lot. Why is cryptocurrency not allowed for home loans?
So,
and are there non-QM products that do allow it?
Yeah, so it's allowed per se, but it has to be liquidated and moved into what I would consider a more readily available account, right? A checking account, a savings account. So someone can have cryptocurrency, but it's all going to have to be liquidated and moved into more traditional accounts.
And
but you can't use it as it stands alone. So it doesn't have to be seasoned per se, but you have to be able to source it. And that's the challenge with cryptocurrency, is sourcing all the trades and the movements of the purchasing and selling of crypto to source those funds into your traditional checking or savings. That's where the challenges is coming in. But crypto by itself, you can't use. Like the value of cryptocurrency doesn't really work for reserves or things of that nature. But if you liquidate, it can become sourced and down payment funds. But that's the process that most people have the challenge with, is getting that type of documentation that's acceptable.
Yeah, so for most of us, guys, when I see a cryptocurrency statement, typically it doesn't have the person's name on it. A lot of times you can get like the Coinbase verification, but it is really challenging. I advise most people to liquidate and keep it in their account for a minimum of 60 days.
I would say I would season it, liquidate, season it, then we don't have to go through the sourcing process.
But the reason for that is because guidelines haven't been written to support cryptocurrency. And generally speaking, there's kind of a lot of guidelines in regards to money laundering practices. So believe it or not, real estate, if any of you've watched Ozark, then you know that real estate is this really great vehicle for money laundering. And and so unfortunately they make us document all large deposits, and they make sure that it's not coming from somebody who's an interested party in the transaction, right? So they want, large deposits or gift to be from family members. They want it to be from assets that you've sold. They want it to be from paychecks, bonuses. They want to know where the money's coming from. Right. Okay. So Matt asks, could you both please talk about co-borrowing on a refinance, the tax implications of adding a co-borrower to title? The co-borrower is my niece and she would move into the property. So I don't know if I 100% understand this question, but generally speaking, if you are adding a co-borrower to the loan that's going to be occupying with you, they're going to be a joint owner of the property. And so when you go to sell that property, both of you will be implicated on whatever capital gains there are. Now, as far as additional taxes for the property, you guys will each owe property taxes, so there is that. And then you'll have to talk to a CPA about how mortgage interest is, divided, if at all, or if it goes to one party or the other party. So that is something that maybe you guys rotate annually if you're going to do itemized deductions, which rarely people do. They genuinely mostly do the standard. So,
Yep.
Did I nail that?
Yep.
Okay. Now, I will say that there's a difference between a co-signer, though. So a co-signer is somebody who just goes on the note of your home, so they don't technically have any ownership in the property, and there are credit implications to that person if you guys don't make the payments on time. And then there's a difference between a non-occupant co-borrower. Most people opt for that. Most lenders require that, and that person goes on title. But again, they have credit implications regarding their debt to income ratio and their credit scores if you don't make the payments on time. So there's that.
There you go.
Okay, so KCH says, are you still seeing people waive inspections along with appraisal clauses? So yes, guys, I'm still seeing it. It is still a really aggressive market. One happy note, though, guys, is that we had under 5,000 listings here in Phoenix around like May, June period, and now we're up of 7,000, which is really great. It means that inventory is increasing. Now, it doesn't mean that anything has really changed in terms of it being a seller's market. Just so you guys know, a balanced market, is 23,000 homes. So we still got a ways to go. So yes, people are still waiving appraisals, still waiving inspections, but it's not as aggressive. So I'm not seeing as many people doing it. I'm not seeing people just waive them willy-nilly. I'm seeing people shortening their inspection periods and then capping their appraisal waivers. So I'm definitely seeing an improvement in that for you guys. How is APR calculated on a mortgage loan? So, fun fact, I have not one, but 2 videos recorded on this topic. And it's like a pretty big math equation. But generally speaking, your APR is the interest rate that you pay on the home plus fees, and then it's amortized over the term of your loan. And so they're just trying to give you a rate at which it's going to cost you overall, just so that you can at a glance compare it to other loans. But unless it's an apples to apples comparison, APRs can be pretty deceiving. Right?
Yep, I was going to say upfront fees and interest, right, over reflected as an interest rate, right, for the cost of your loan.
Okay, so this is a good question, and I have, because I have had different.
It makes me nervous when you have good questions.
Well, because I've had like differing questions from underwriters on this one. So you know how like so many self-employed people took out SBA loans? Mm-hmm. How does this impact their home loan?
Okay, so I don't see them. I see them, but not as often. So an SBA loan will sometimes be cross-collateralized, right, against your primary residence, right, your house in that case. So in a case like that, the SBA will usually come off, allow you to close your transaction on your refinance, and then go back on after closing. So that's traditionally how it will happen. They don't really subordinate, they release, and then put back on afterwards.
What about the PPP loans?
So that's been, again, the hot topic, right, with COVID and everything going on with the loans. So the PPP loan from a lending perspective, right, as it pertains obviously to self-employed borrowers, it's not considered income, right, for the borrower, because the PPP loan is not a generation of income. It's more of a cash infusion, right, into the business. So it shows up on your balance sheets, right, so it shows up in your cash account, but it's not an income source. So from an underwriting perspective, when we're analyzing a self-employed borrower and looking at profit and loss statements, right, the PPP loan cannot or will ask for it to be removed from any of the income equation as we go through that process.
Yikes. So as somebody who qualifies a lot of loans, typically what I do on a self-employed borrower is I'm looking for whether or not this is on a bank statement. right? Because sometimes what the underwriter, and please cover your ears, what the underwriter does not hear and or see doesn't impact the overall underwriting of your loan, which is why it's so important to get pre-approved, right? So you want somebody like going over all the financials, excluding information that may harm or add more conditions to your home loan or deduct from your income, right? So super, super important about this. And you definitely want to disclose these things, right? Because I had one client who was getting a PPP loan for their down payment funds. And obviously that is not allowable funds. You're supposed to be using that for your business. And so many red flags there, right? So just an FYI on the importance of getting pre-qualified. Alrighty. Well, guys, we're just tapping up the hour. Time for at least one more question if you guys have it. So go ahead and post below. And I'm going to tackle one last question here. And this is about child support. And I do find that this comes up quite a bit. So I have monthly child support out of wedlock. My broker said that they have never dealt with this before. Can I use this for qualifying for a home loan?
So if there's that's challenging because you're gonna, the problem you're gonna run up against with this outside of, well, I'll answer it the other way. We're going to need some type of formal agreement or arrangement, right, with the courts that show that you are not allowed but approved, right, or you're entitled to those monies. And then we'll need proof that you've received at least 6 months of those monies consistently at the rate that's documented within that legal agreement. And then we look for continuance as well, right? We look for the 3-year continuance. But the key here is it has to be documented through some type of court order or some type of formal agreement that's a legal agreement that can be enforced.
So here's how I've gotten past that in the past. So I've gotten a notarized document between two parties that verifies when the agreement started and what the amount is going to be. We document with 12 months worth of receipt of payment via bank statements, and we include a birth certificate that shows both parents, right? And so that's how you would document something like that. The fact that the broker hadn't dealt with that before just means that they haven't seen enough files. And this is where, again, like I said, guys, resourcefulness and speaking to your underwriter is important. So it's a legal binding agreement, right? So just so you guys know, depending on your state, a verbal agreement can be a legal agreement. And if they've continuously paid, which is what they want to see, a history of receipt of this income, right, you can use it, right? And so you just have to find somebody who is tenacious enough to interpret the guidelines, bring it to an underwriter, get them to sign it off, right? So don't let this discourage you. Now, I will say that whenever you use child support or alimony to qualify, it does have to have a 3-year continuance and something that isn't super confusing. So sometimes you have somebody who's like 18 years old, but the child support says that they're going to continue all the way to that person graduates college. That will not work because you can't guarantee that they have to, go to college. You can guarantee that they have to finish high school, right? I mean, for the most part, okay. But you can't guarantee that somebody's going to go to college. So it just has to be very crystal clear that there's 3 years of continuance, like the child is 10, right? And you got 8 years left, right? So just an FYI on that. And if there are any skipped payments, any missed payments, any inconsistencies with the amount of the deposits, they probably won't let you use it.
Yeah, I think that's the key there, Lizzie, right? It's a legal agreement's not necessarily a divorce decree, right? There's other ways to document a legal agreement between two parties. So that's great to hammer home.
And then Bravebird says, can you use child support even if it's not claimed on taxes? To my knowledge, I've never seen child support claimed on taxes. I think you only have to claim alimony, truthfully, but again, I'm not a CPA. So yes, you absolutely can, again, with a legal agreement and verification of at least 6 months worth of receipt or 12 months worth of receipt if it's not a new agreement. So
yeah, and in many cases, you're not even going to have to provide tax returns depending on your client's profile. So I wouldn't worry about the tax returns on that piece.
So what Tom is meaning, he's been trying to pound this through my entire branch, is that when you run the automated systems, technically a lot of times you don't have to provide paycheck stubs, W-2s, tax returns. A lot of times we ask for this in pre-approval because AUS findings are not super consistent. But typically when you get into underwriting and the underwriter's already reviewed it, chances are we will not need your tax returns unless you are self-employed or commissioned more than 25%. So
bingo.
Yay. All right, guys. Well, this is super fun.
Well, thanks for having me.
Were
I
you
actually
scared?
enjoyed this.
Okay.
It took me a little while. I was a little probably staring down half the time as it all started, not know where the camera was. But no, this was a blast. I got obviously more comfortable as it went on, and I would do it again.
Yay. So, guys, tune in every single Wednesday for more of your questions answered live. I have a great video that I'd love for you guys to check out. And also, if you have any additional questions, want future video ideas, post them below. I'm doing a giveaway that ends next week for best video idea. So thank you guys, and tune in to another Live on Wednesdays.
Thank you.